Okay, students, without further ado, let's go on to discussions on papers, right? Discussion on papers, which is very important part of our program. So we will move on to paper discussion without sticking on theoretical parts, right? So firstly we will discuss on December 2024. Now student, when we are looking at these papers, there are many views, different views in suggested solution. So don't stick into suggested solution, just learn all the answers with me, right, without sticking into suggested solution given by the institute, because act has been changed and there are different views in suggested solution which I will be explaining, right, which might not be the correct view or some different view, right. So first, December 2024, we will start from question 1, good question, as we discussed on non-resident person taxation, right. Yeah, we will read the question. Firstly, when you have taken the question, you should look at requirements and analyze the time that you need to spend. 25 marks, and you need to calculate time per each section, right. 10 marks, what is the time? Basically for one question you have 1.8 minutes. 10, that's mean 18 minutes. Within 20 minutes you would finish it. 6 mean something around 12 minutes, right. 5 means something around 10 minutes, and 4 means 8 minutes. You have to mark the time and you have to have a watch with you to count the time for each section. You write, stick into time, go to next question. That's how you score marks, right. So first you understand the requirements. First there is a computation to be done. Then there is a essay type question, explain. Again a computation on individual question. And financing method, individual how to finance their asset purchase, sufficient income purchase the apartment, right. So you have to read the question and answer. First one, compute the income tax payable by the stock, maybe a company. Then explain the tax obligation of Orak Singh, Sri Lanka, maybe a non-resident person, permanent establishment, right. Compute the accessible income of Ramesh, individual. Explain Ramesh how he can purchase the apartment, right. This is 23-24 year of assessment. We will stick on to that, but with the amended laws updated at the current time, right. We read the question. I have already marked the important areas in the question, right. So at the exam you have to read all these things, right. You have 3 hours and 15 minutes. Section 1 and 2 and 2 questions from section 1 and 1 question from section 3. Section 2, there is it is connected to precinct given to you, right. So this question is very easy to get mark. We will see how you analyze questions. Question 1. Storm Research Inc. is a company operating in the United States of America. Very important. Now as you know, there is a difference under section 4 for a Sri Lankan company tax and foreign company to be taxed. Now it's a company operating in the United States of America, USA, which is engaged in the business of providing business analytics and marketing research data to companies in USA and other countries. Remember that, right? So these are very important. Nature of business, the location, everything is very important when you do the computation. The company is heavily reliant on its online data gathering platform and has a team of professionals who is qualified in computer science and data handling. Storm has registered an overseas company in Sri Lanka and its IT support team operate from an office in Bambalapitiya. Very important. This might be the relevant part for us. Storm has registered an overseas company in Sri Lanka and its IT support team operate from an office in Bambalapitiya. Now this is an overseas company, right? Student, overseas companies, are they resident company or non-resident company? There are arguments. When we are reading the section 69, there are arguments. But for overseas company, this is a foreign company. It is not incorporated under laws of Sri Lanka, right? It's not incorporated. It is just a mere registration under section 459 of Companies Act, right? It is registered under the Company Act, not that it is incorporated in Sri Lanka. So it is a non-resident person. We will look at when we are doing the computation. I will explain one by one. The Sri Lankan team has 30 IT professionals and 6 support staff. So when you are doing the reading this, you have to write everything, right? Storm, USA company, USA, right? In IT and data handling. Now we learned there is a company called Storm in USA. You just once you are reading, at the same time you just take a rough sheet and draft this, or in the paper itself. And they have established a overseas company in SL, right? Overseas company in SL, right? Work from home and office in Bombay can only accommodate 10 employees at given time. The team maintains accurate logs on time spent on each assignment. That might be important, right, for certain cases. At the end of each month, the local office sends an invoice based on the time spent for the service performed in Sri Lanka. Right? Now what they are saying? Record time spent invoice to overseas company, right? The hourly rate incorporates the cost related to staff, including salary, EPF, ETF, gratuity, etc. Right? The hourly rate incorporates cost related to staff, right? So they are charging based on the hourly rate and it is including cost related to staff. So they charge the Sri Lankan overseas company incorporated by them in Sri Lanka, record their time spent on their work and they invoice to USA company, right? Right. the income statement of Storm Sri Lanka for the year ended 31st March 2000 is as follows. Revenue, and it's given the general P&L. Salaries, EPF, gratuity, software license, interest income, and overhead expenses, head office expense also there. When you are looking at this, you should remember something, right? There is a provision for head office expense deduction, right? So you should remember everything. That's why I said you have to read the entire act, right? Rather than administrative provision, these sections you have to non-resident taxation, section 69 to other provisions, transfer pricing sections, everything you need to read, right? Right. The following details have provided by the accountant, right? Without reading this, revenue includes invoice totaling $100,000, right? The balance revenue from invoice issued to Orange Olympic is a large investment company incorporated in Sri Lanka, right? Just rough reading is required. Software license have been obtained from Orax, right? There is a software license. Capital allowance, right? Gratuity payments. Withholding tax case also there. Now the rough reading is there, right? These are adjustment items, no? So this comes when you are starting computation preparation, right? Storm says you have to read it again. That's why I am going fast, right? That's why you need only rough reading. Right. Next, Storm has employed Ramesh Fernando as the CEO of its office in Colombo. Ramesh, CEO. Ramesh. He is a software engineer who has worked in US for 25 years. He has been residing in Sri Lanka since January 2023 and has registered for income tax in Sri Lanka. He has been residing in Sri Lanka since January 2023. See that. The question itself says he is residing in Sri Lanka, right? He is residing. Now, you should, I hope you are understanding every section. So, there is a term in the act, residing. Under section 69, individual considered to be resident individual if he is reside in Sri Lanka, right? His T10 form from the employer provides the following details. Gross annual salary 29.5 million, APIT deducted 9.7 million. In addition to the Ramesh has the following income. Now Ramesh income has been given, right? Ramesh has made payment of 3% quarterly self-assessment payment. That's also given. Ramesh has also confirmed the following. Bank balance, cash in hand also given. And in general, Ramesh purchased an apartment in 𝐂𝐜𝐿 for value of 75 million. Right. That's also given. Now this is rough reading, right? Extract of Article 5 and 7 and 12 of double tax agreement between Sri Lanka and are given in Annex 1 Now definitely there will be involvement in DTA, double tax avoidance agreement, not double tax agreement. Examiner is wrong in this case, right? There is no something called double tax agreement. It's double tax avoidance agreement. It's double tax avoidance agreement. DTA, right? DTA. There is no agreement called double tax agreement. Double tax agreement meaning that there is an agreement to tax the person double. You are taxing same person twice. There is no such agreement. Double tax avoidance agreement is there to avoid the taxation of one person two times. right? Agreements are called double tax avoidance agreement, not double tax agreement. If someone is referring as a double tax agreement, that means he is not aware about tax law. So your examiner is mentioning it as double tax agreement. I don't know whether he is aware about taxation, right? Compute the income tax payable by storm, including remittance tax for year of assessment 23-24. Now you might be confusing what is remittance tax. You have gone through all the section, all the relevant section for your curriculum. You know what is remittance tax, right? But we'll see what is remittance tax. Compute the income tax payable by storm, including remittance tax for year of assessment 23-24. Right. First step in doing a computation. What is the first step? Right. You need to understand who is going to be taxed, right? This is a company. Company, right? So company, not an individual. Who is the person? A company, right? Now then you have to understand, is it resident or non-resident? Resident or non-resident, right? Or PE, you need to understand whether it is permanent establishment, PE. Right, students? So in this case, we learn that residents are, if a company to be resident, we learn, I'll go to my notes. Company incorporated or established in Sri Lanka, place of effective management should be in Sri Lanka, principal office should be in Sri Lanka if a company to be resident. But in this case, storm case, what happens? There is a company in USA and they have established a branch office in Sri Lanka, right? Branch office in Sri Lanka. So that is an overseas company. They prepare accounts as a normal person, normal Sri Lankan company, but this is a overseas company, right? So it is not a resident company, it's a non-resident, right? I am explaining the long way of doing the computation, but at the exam you don't need to think this much, but I need to explain everything for you through question. That's why I am explaining everything. So in our program the specialty is we touch upon every section in detail when doing the question, right? That's why I just glanced through the sections earlier. I just glanced through the Inland Revenue Act sections only without going into much detail, right? So now we are touching every section in detail based on questions, right? So it is storm is a non-resident. Not a resident, it is a non-resident, and then you are look at whether it is a permanent establishment or not. Here they have fixed activities, fixed place of business in Sri Lanka. PE defined as a fixed place of business in SL, right? So if we go to definition, I'll go to definition. Now this is how you refer the act. Section 195 definition, right? I'll go to definitions. Here, as I explained, in this act, unless context otherwise requires, it is defined as a Sri Lankan permanent establishment. Right. Sri Lankan permanent, any business connection or fixed place of business through which the business of the enterprise is wholly or partly carried out, irrespective of number of days of such business being carried out in Sri Lanka. Right? So, PE means basically fixed place of business through which business of enterprise carried out. Fixed place of business in Sri Lanka. So here, do this storm overseas company has a fixed place? Yes, there is a fixed place. They are doing business. That's why they registered the overseas company. Overseas company always equal to PE. Remember this. This is the short note. Overseas company means it is a PE, right? If it is a overseas company, that means it is a permanent establishment. So there is a fixed place of business. So when there is a permanent establishment, students, how you gonna tax it? If it is a permanent establishment, as normal SL resident company, right? If it is a permanent establishment, you tax it as a normal resident company. I'll write it again because it's very important to understand the concept clearly. Company. Resident, non-resident. Then you look at PE whether it is a PE or not a PE, right? Fixed place of business. Resident, non-resident, whether there is a fixed place of business or not, right? If there is a fixed place of business, treat as a person, deemed to be a person. Act provides, I'll show that. Act provides if it is a permanent establishment, it is deemed to be another person for taxation. Resident company means a person, right? So here when comes to non-resident, it's another person, but here treated as a person separated from this person. This is a person, right? Now we are looking at this person, whether a resident person or non-resident person. We found it is a non-resident person. Then we looked at whether it is a PE or not. Now we considered it as a PE. Once it is considered as a PE, we treat it as a separate person from head office. This person and this person is two different entities, right? This person and this PE company, foreign company. Now in our case, right? Foreign company and overseas company. Overseas. Now always remember, overseas company equal PE, right? If it is overseas company in Sri Lanka, that's a PE. So it is a separate, treated as a separate person from the head office, right? From its head office, it is a separate person. And business income and all other income calculated in similar way for a resident person, right? But only thing is, only to the extent of source in Sri Lanka. Here it can be mentioned here, source in Sri Lanka. Source in SL, taxable. Only source in XL will be taxable, but treated as a separate from company from its head office, right? So it is there under section 66, right? So students, section not 66 of section 76 and 77 provide that it is a separate entity from its head office, right? So computation is more or less similar. The same provision applies. Section 6, 5 things apply, but for the source of income in Sri Lanka, right? Non-resident person source in Sri Lanka will be tax only, right? So let's go to our question. Now we clarified how it's going to be taxed. Now go to taxing it. Right. First step of doing any computation is to draw your format. Format is storm. Company name. You don't need to write everything very clearly at the exam because you need to save your time. At this level, we are not, I hope examiners is not worry about your handwriting. If it is clear, if they can see and read it, that's enough. And formatting, nothing is important than the answering correctly and giving right point at the exam, highlighting right point. Storm, right? Sri Lanka, Storm SL. What is the name? Storm, by Storm, right? Storm, income tax computation. Income tax computation, right? So you have to write. I'm just giving understanding here. First I said format of computation is you have to compute assessable income from employment, business, investment and other income first. Here do they have a employment income? Being a company, they don't have a employment income, right? Right. Being a company means they are not employed by an employee, right? They are in the business, not the employment. Assessable income from business. Assessable income from investment. Assessable income from other. Right? Then total assessable income. Total assessable income. Right? Then less qualifying payment. Qualifying payment. then comes to taxable income. Then tax rate. Right? Then gross tax liability. And being a non-resident, you need to compute remittance tax also. Remittance tax. Then total tax liability. Total tax. Then deduct tax credit. Right? Here there should be a column to do all these computations. Then there will be a tax credit, then net tax liability. That's the structure. That's the structure. Right? So we will see how to do each one. So this is the structure that you need to prepare. Right? So tax rate you have to determine. Right. First. Now we said assessable income from business. Right? Now you are going to do the computation actually. Now when you are assessable income of business, you need to compute. Not, you are giving a not number, not 1, then starting it. Tax credits, tax liability. Note 1, assessable income from business. Right? So let's go to question. Compute the tax payable including remittance tax. So we are going to section that says about this company. The income statement of Storm Sri Lanka for the year is as follows. Revenue given, gross profit given, overhead given, net profit given. Right? First thing we take profit before tax. Now you are doing the adjustment. Plus, minus, right? You take 2 columns. First starting point is profit before tax. This is the indirect method of doing the computation. I will explain that also. Computation direct, indirect. Right? Direct method means, students, you take, examiner can test this, take all income and less all expense, not all, under act, as per IRA, Inland Revenue Act. You take all income, expense, then take profit. That's how. Then tax liability, right? That's how you are doing direct computation. That means it's similar to your P&L, profit and losses statement, right? So you are taking income, expense, then profit and then tax liability. That is the direct method. So indirect method means now you have the profit already computed in your financial statement. You take PBT. Now in arriving this PBT, you have done, you have taken all your income and expense, most of your income and expenses. Now it is prepared on accounting terms, SLFRS, right? Accounting standard terms it is prepared. Now you do tax adjustment, then tax profit. Now indirectly taking accounting profit, you do adjustment and get tax profit. The adjustment, in the sense there are different adjustment, so both adjustment, all the adjustment are included under plus and minus, right, depending on the nature. If there is a income that should not be taxed, what we should do is, now let's say there is a profit, when computing that profit, that income is included, so to remove it we take it to minus column, right? That's how. I hope at your level, at a strategic level, you have done all these things, right? So I am not going to explain one by one, that is relevant to lower levels, right? PBT, how much it's given, right? I am not going to write everything in the board, but it's, I'll show the computation here, right? Right. Profit before tax, they have given it as 11,926,29, right? This one. So I have taken this, so I mark it, right? I mark it, right? So first adjustment done. Next, from profit before tax, you don't directly go into other details in the P&L, right? You don't directly go into P&L details. What you do is, you go to adjustment. Revenue includes an invoice totaling USD 180,000, which has been invoiced to Storm, Research Inc. in the USA. And payments for all invoices have been received in foreign currency through a bank account in Sri Lanka. See student, now there is a foreign currency earning for this company. Now this is similar. Now we are doing the company for permanent establishment, which is a separate entity from its head office or other subsidiaries, and it's a Sri Lankan company for which only source in Sri Lanka will be taxable, right? Being an unresident, right? Now they are saying there is a two part of revenue, right? Revenue has two parts. Revenue has two parts means they are doing two activities, right? Two activities per se for our act, right? Which has been invoiced to researching in the USA, and payment for all invoice have been received in foreign currency through a bank account in Sri Lanka. The balance revenue is from invoices to Orange Holding PLC, a large investment company incorporated in Sri Lanka to develop data analytics and model to analyze potential investment in Sri Lanka. So I am going to explain that part. Revenue. Right? There is a foreign revenue and local revenue, students. So now Act says, I'll show you foreign revenue. Foreign revenue means foreign service income is exempted from the tax provided it satisfies certain criteria, right? and local revenue is liable to tax at normal rate, which is 30%, right? So now your business has two parts. One is exempt, one is taxable. Taxable, exempt, right? Exempt. Taxable, exempt. So you need to compute exempted profit, right? Not the income. Remember that. You don't exempt the income. Remember, as a golden rule, remember, many practitioners also, not many, trainee practitioners get this wrong, right? So someone, if they are training in the tax field, they get this wrong, right? I have seen some companies, even after reviewing it, they get it wrong. They exempt the revenue, not that you are exempting the revenue. You have to exempt the business gains and profit. Exempt gain and profit. Gains and profit. Profit means after deducting expense, income minus expense. So you have to compute exempt gain and profit related to this foreign activity. Service supplied to foreign countries. Liable gain from this activity. Separately you have to determine, right? You have to determine it separately. Students, now it's given that there is a foreign revenue for payment, for which payment received in foreign currency, and there is another revenue from local currency. That means there are two activities for the purpose of Income Tax Act, right? So there are two activities. The students, under Inland Revenue Act, if there is a gain that is taxable at different rate, you have to prepare different financial statement, or you have to prepare your computation in different separated from each activity, right? So I'll explain further. That's it. Now you might now aware that foreign revenue, earlier it was exempted, now it's taxable at rate of 15%, and local revenue taxable at rate of 30%, right? I'll go through the section again to show you how it's termed in the Act, but before that I'll explain roughly. If there are income taxable at different rate, these gain and profit from these income, these business activities should be computed separate from each other, right? Separate financial statement should be here and separate financial statement should be here as per the Act, right? Wording in the Act, right? However, Act also provide, if you can't prepare separate financial statement, if it is difficult to, if there are common expense incurred for both activities, if it is difficult to prepare separate financial statement for different activities. Why I am saying this is different activities taxed in different rate, activities taxed in different rate, should have separate financial statement. But if it is difficult, you can separate the gain and profit based on their revenue proportion, student, right? Based on revenue proportion, you can separate your gain and profit, right? I'll show you the relevant sections. So student, tax rates are governed under first schedule. We learned that section 2 provides, section 2 charging section says that gains and profit taxable income taxed at the rates given under first schedule to the Act. So first schedule determine what are the rate of tax for a company. First schedule, item number 4, right? Para number 4. Para 4 says what is a company tax rate. For each person there are different tax rate. For a company, now we are doing a computation for a company which is a permanent establishment in Sri Lanka, right? So we will see first schedule. Here first schedule, here it is given governing section. First schedule, tax rate, title and governing section. Tax rate for resident and non-resident individual, right? That's paragraph 1. Paragraph 1. It is not relevant for our case. Now let's go. This schedule has been amended many times, right? So why I am scrolling for you to see, you need to learn how to do that also, right? Tax rate of a partnership given. Next, it is amended. You cannot blindly write everything mentioned here because each and everywhere it is amended. You need to properly select what is relevant for your year of assessment. Right? Tax rate of a trust. Now come to tax rate of a company. Here, subject to paragraph 2, 2A, 2B, 2C and 3, the taxable income for a year of assessment, company for a year of assessment. See, prior to January 1st, one thing. From with effect from January 2020 to April 2022, another rate. Right? Then again another rate for first 6 months commencing from April 2022. Here, with effect from April 1st, 2023 shall be taxed at the rate of 30%. See, how to read it? Subject to below section. If these sections say something else, that's apply. Subject to these section, tax rate is 30%. 30%, right? 30%, right? So what's the understanding from this is general tax rate. General tax rate for a company is 30%. Remember that, right? That need to be remembered, right? You cannot forget it. General tax rate for a company is 30%. So in our case, general rate, general, or we call this standard tax rate. Standard, this is the most used word. Standard tax rate, 30%, right? That is under 4.1, first schedule 4.1. Then comes to specific circumstances, specific rates, right? Then comes to specific rates. Let's see what are the specific rates. So I am explaining in detail that our method of teaching you is firstly go through questions, then explain in detail each section, right? The taxable income of now these are the specific provision. The taxable income of a company for a year of assessment prior to January 2022. So it's not relevant for now. 2 not relevant. 2A, such part of gains and profit of a company for a year of assessment shall be taxed at the following rates with effect from January 1st, but prior to April 22 and for the first 6 months of year of assessment commencing on April 22. Right? Now it's not relevant. It is relevant before April first 6 months until September. Right? Now it's no relevance. See the dates. Right? So in the exam, if you can't bring this consolidated action, you have to remember this. Or in your action, you have to write it. Original action, you have to write the amended provision and prevailing provision in the time you are doing the exam, right? So prevailing provision we will find out, then you have to write it in your act itself. So there is no hassle when at the time of exam you don't need to go here and there in the amended act, right? If you can bring consolidated act published by Department of Inland Revenue, that is better. But if you can't, if examination department does not allow it, what you can do is you can write prevailing rates in your original act without going through amended act, right? So you can highlight it. Right. Right. 2b. Such part of the gains and profit of a company which include taxable income of 6 months period commencing on April 12 for the year of assessment, for any year of assessment commencing on or after April 2000, but prior to April 1st 2025. So it's not relevant for your exam. This is also prior to April 1st 2024. Your exam purpose most probably it will be tested for year of assessment 2025-26. Right? 2025-26 might be tested. Right? Right. Such part of the following gains and profit of a company which includes its taxable income for any year of assessment commencing on or after April 1st 2025, the gains and profit of a company shall be taxed at the following rates. Right? Gains and profit earned or derived from any service rendered in or outside Sri Lanka to any person to be utilized outside Sri Lanka, where the payment for such service is received in foreign currency and remitted through a bank to Sri Lanka. Right, student? This is a very important section, right? Very important wordings. Gains and profit. Here, such part of the following gains and profit of a company, not all. Below parts, there could be a part of profit. Such part of following gains and profit of a company which includes its taxable income. Which includes in its taxable income. In its taxable income, if there are any part that relevant to here that classified as below, that will be taxed at the rate mentioned in below. Right? For any year of assessment commencing on or after April 1st 2025. Gains and profit earned or derived from any service rendered in or outside Sri Lanka. See the criterias. Now criterias. I'll go into different slide. Gains and profit. Without writing that word, I'll directly write the short one. Earned or derived from any service rendered in or outside Sri Lanka, right? So there is no difference. You can perform the service in or outside Sri Lanka, maybe in Sri Lanka or outside Sri Lanka, right? You can do the activity in Sri Lanka or outside Sri Lanka. There is no difference, right? To any person derived from any service rendered to any person, service rendered to any person to be utilized outside Sri Lanka. Very important. To be utilized outside Sri Lanka. Utilized outside Sri Lanka. This is the important part. Right? Service rendered to any person utilize outside SL. this word is very important. Utilize outside Sri Lanka, right? So this is interpreted in many ways, right? So in our case, we have to look at, in given case, whether service is utilized in or outside Sri Lanka. Utilization is some factor students, some are saying if consumption, some are saying consumption and utilization is different. So term utilization means you utilize for your business, not that end consumer consume it. It's utilized for producing another product, maybe. Some are defining it as a consuming also, right? I'm delivering lecture, some foreign student listen to me and learning from me. So he consumed it. So consumption and utilization could happen together, right? And you can separate it also, right? So your service should be taken someone in outside Sri Lanka, right? And the service should not be utilized in Sri Lanka. It should not be taken to his production of income within Sri Lanka, right? There could be some services you provide in Sri Lanka to person in outside Sri Lanka, still it could be utilized in Sri Lanka, right? So this is not like that. Utilize outside Sri Lanka. In our case, let's see other criteria also. Where the payment for such service is received in foreign currency and remitted through a bank to Sri Lanka. Through a bank. Next one, next criteria. First one, utilize outside Sri Lanka. Second one, payment in foreign currency. Payment in foreign currency through a bank, right? Payment in foreign currency through a bank, right? It should be received through a bank, right? So let's say I'm delivering a lecture to individual student in a foreign country. Right? Let's say I'm a company. Now I'm in a company as a lecturer. We are delivering. Our institution deliver lectures to foreign students, and they pay cash, not the bank transfers. Right? They pay cash for us. So then, can we take that claim? This lower rate tax rate. So in that case, we can't. Right? In that case, we can't. So here in our example, let's see, through a bank, received in foreign currency and remitted through a bank to Sri Lanka, right? Here another 15% rate, foreign source of payment. But today in our discussion, the service fee is there. We are providing as a company. ISTOM provides a service, right? Provides a service, so foreign currency being received. In our question, let's see. Yeah. Revenue include invoice total into USD 180. Foreign currency criteria done. Which has been invoiced to ISTOM research in foreign person. And payment for all invoice has been received in foreign currency. Foreign currency payment received through a bank to Sri Lanka and exchange rate given, right? So, any gains and profit relevant to earning this income, right? It is not the revenue being taxed at the 15%, right? Some are getting this wrong. You cannot tax the revenue at lower rate of tax. You have to tax the profit. Tax profit, right? Not the revenue. You have to take income plus expense, then tax it. But in our case, we don't have a separate P&L given, right? We don't have a separate P&L given. The balance revenue is from invoice to local company. That is taxed at rate of 30%. This is taxed at the rate of 15%, right? So, write it. So the next question, whether this is utilized in Sri Lanka or not. So for that we need to understand what is the service they have been mentioning, right? Let's see what is the service, nature of service. That is simple. Why I have highlighted it here is because of this. 𝐿 has registered overseas company in Sri Lanka and its ITSM operate from an office in Bambalapine. Right? They are in the business of providing business analysis and market research. So Sri Lankan company also, we can assume, providing the same service, and this has been utilized by their head office, separate entity, as I explained earlier. They have utilized it in foreign country. So it is utilized outside Sri Lanka. So entitled for lower rate tax rate. Lower tax rate. Entitled for lower tax rate, right? This is for your understanding. Still we are not in the writing of answers to computation, right? Balance income will be taxed at the 30%, right? Foreign revenue 15%, balance is 30%. So I said you need to have separate financial statement. So where does it says? Let's see. So students, where is it stated that revenue gains and profit from different tax rates should be computed separately? You should prepare separate financial statement when there are different tax rate available to your business. Where it says, right? So it says under record keeping sections, students. I'll show you the section. Chapter 10, record keeping and information collection. Now I said you need to prepare separate financial statement if there is separate tax rate. If you can't prepare, you can divide your taxable income in proportion to your turnover or asset usage, right? Remember that. I'll write it like this. Different tax rates or exemptions, then prepare separate financial statement for business under each tax rate or exemption if cannot identify separate gain and profit for each tax rate or exemption using turnover proportion or asset usage. Turnover proportion or asset usage. So if there is a separate tax rate or exemption for your business, you need to prepare a separate financial statement. If you can't prepare, if there are common expenses being incurred for all the activities, you can divide your gain and profit using turnover basis or asset usage basis. It will be more clear when we finishing our computation, right? I'll explain how it's been done. 120, this requirement is coming under section 120, right? Record keeping and information collection, a taxpayer. I am not going to read this section, I am going to read the relevant section. With effect from the year of assessment commencing from April 1st, 2021, where any person is engaged in business or investment activity and the income tax payable shall be calculated applying different tax rate for such part of taxable income from any gains and profit from business or investment activity or may have exempted amounts. As the case may be, such person shall maintain and prepare the financial statement to separately identify such part of taxable income from gains and profit in applying each income tax rate to each part of the taxable income or to identify the exempted gain and profit, right? So that's mean the things we have discussed is stipulated under this section, section 121A, right? Now see, only one note has been given. How many sections that we have covered? Section 2 covered tax rate, first schedule, reference to first schedule. Section 4, resident, non-resident. Section 69, again resident, non-resident. Section 67, 77, where permanent establishment is treated as separate person and is computed as a separate person in Sri Lanka, that is separated from its head office. Then we came to paragraph 4 first schedule. Then we are going to section 120. Now 4 sections have been covered here. 4 areas. We have discussed 4 areas, just one note, first note. See, just with the first note, I have covered 4 areas. Now it says there should be a separate financial statement if there is a difference in tax rate that you are applying or if there is a exempt gain. To identify what is exempt gain, what is the gain from 15%, what is the gain from 30%. So there should be separate financial statement prepared, or it does not say separate financial statement. In more technical manner, it's a financial statement to be prepared in a way that we can separately identify these gains and profit, right? You don't need 3 financial statements. What is mentioned is 1 financial statement, but in that financial statement you should separate each gain and profit from each activity, which is taxable at 15%, which is taxable at 13%, which will be exempted if there are any, right? In our case, I am taking 15% and 30%. In different case, it will be different rates and exemption, right? So next, provided however, in the case where such person has commonly incurred expenses or commonly used any assets on all business or investment activities, and any expense or deduction cannot be separately identified for the purpose of this subsection, it shall be lawful to divide such expenses or deductions on a proportionate basis according to the proportion of turnover, proportion of assessed usage in preparing such financial statements. See, now we know our revenue, how revenue is being treated. If you have service income, foreign service income for which foreign currency receipt which is utilized outside Sri Lanka, it is 15% for the year of assessment 25-26 onwards, right? If it is earlier year, it is exempted, right? But I am using this 2024 correction. I am computing liability based on latest amendments, right? So it is liable at 15% and balance will be liable at 30%. Now we know the revenue rate to be applied for the revenue. We don't know what happens to expense. So in our correction we can reasonably assume that expense, we have only one P&L. It is not separated for foreign services or local services. So we can reasonably assume that all expense incurred commonly in generating all revenue items, right? All expenses have been incurred commonly in generating all revenue items. So we can reasonably assume that, right? There is no any other assumption that we can make. Right? We cannot separate all the expenses. In our correction, if we are going to correction students, they have given one P&L here, right? So we cannot say that EPF, from EPF, this EPF is for foreign one only, local one only. This rent is for local business only. We cannot assume that. It's given only one P&L. So it's obvious that all the expense incurred commonly in generating both revenue. So in that case, what's happened? How law says? So I am explaining these things in detail, but in simple terms also I can explain. Why am I explaining in detail? For you to understand better with the law. But these are the things that you can remember, practice and very quickly apply at the exam, right? This much of detail you don't need at the exam to apply, right? But for you to understand, I am giving every reference in that. So this is like a Bible, right? Whatever we do, there should be a provision in that, right? So remember that whatever you do, there should be a provision in that. Here there is a provided away in the case where such person has commonly incurred the expense or commonly used any asset. Now in our case, we incurred expense commonly, right? In the case where such person has commonly incurred expense or commonly used asset. I said on all business or investment activities, right? We have two activity, foreign service and local services. We incurred expense commonly for both activities. And any expense or deduction cannot separately identify for the purpose of this subject. It shall be lawful to divide such expense or deduction on a proportionate basis. We can proportionately divide it between two activities, two business activities, or exempted one or investment one, right? And for the purpose of this, it shall be lawful to divide such expenditure or deduction on a proportionate basis according to the proportion of turnover, proportion of asset usage in preparing such financial statement. Proportion of turnover, proportion of asset usage. You can divide these expense in proportion to your turnover. That is the very reasonable basis for you to allocate your expense between two activities, right? So remember that. And asset usage also. Let's say you are a manufacturing company, you have a one product that is taxable at 13% and another product that is taxable at 15%. Both are prepared using a similar type of machine, right? Product A may be less number of quantity, but you are selling at a higher price, so high turnover but less involvement. So you use a less number of activity, the machine hours, right? But product B, higher turnover, less price. So your revenue from product B is lower and revenue from product A is very higher, but activity level is very low. But product B, high activity level, low revenue. So in that case, turnover proportion will not be the reasonable ground for allocating expense. It's like your activity based accounting student, right? So you take your machinery hours and allocate it. Asset usage, machinery hours, right? Asset usage hours, and you can allocate it. In our case, it is not there, just for your understanding, right? There could be something like that also. So this is section 121A. So that's what I explained here and there. So let's go to our question. Not question, answer. Now we have taken the profit before tax, plus minus columns. Now we discuss about. First note. Right? Revenue includes USD 180 and balance is from local service. This is the first two notes. So how you do? You take a separate note in your computation, right? You take a separate note. But at the exam you can keep it for last adjustment also, if you can remember it. Or else take a new page and write it. Note without giving the heading. Now still you can't give the heading. Or else in your format, you know now there could be two tax rate. In income tax liability computation, you can mention two tax rate, 30%, 15%. Business income local, business income foreign. You can mention note number in here, right? In the format. First page of computation in the format. In the place you computing the liability, you can mention two items. So you can make a table like this. Revenue proportion, computing the revenue proportion. You take total income under each revenue category. Each revenue category you take total income. Here you take 180,000 into 300. 180,000 USD into 300. Here 180,000 into 300 USD. 1 USD equals rupees 300. Then 180 USD equal 300 into 180. Right? Simple mathematics. I am not going to explain all this. So you take foreign income and you take local income. How you take local income? Take total income minus foreign income. Right? So you find out the revenue proportion. Take the total 54 million divided by total revenue. 30 million divided by total revenue. So you take the proportion, percentage, right? Percentage here. You take the percentage here. That's all. You don't know about the assessable income yet. You haven't done it yet, right? We will do it. We will do it separately. Right. Next note. I hope now these are very clear for you. All the section involving in here are very clear for you. You read again and again and understand. Right? Next one. Software license have been obtained from 𝐂𝐻𝐶, a listed company in USA, and the withholding tax has been deducted when making the payment. Software license have been obtained from 𝐂𝐻𝐶 and withholding tax have been deducted when making the payment. Right. So now you have to make adjustment to your profit, right? Business income computation. Here with this, what is the adjustment that comes to your mind? Right? What's the adjustment that comes to your mind? With this, you probably thinking that if the withholding tax has not been deducted from a payment, you cannot allow it as a deduction. Where it's indicated? Where it's indicated? It's indicated under section 10 of that. Now another section being tested, right? See how many sections are being tested from one computation. Let's see. Section 10. I'll explain each one by one, right? This one, section 10, disallowable deduction. First, no deduction shall be from the employment income, then below deduction are not allowed, right? Subsection 1. Subsection 2, this is a very important section. For your exam, you understand it in this way, right? For your exam, right? This is how I teach you to learn, right? How to think. This is how how you should learn how to think. Now read this once without taking any, now forget all the things that you learn about this section, right? Forget everything or forget all the tax, right? Think that you are a guy who never heard the word tax, right? Guy never heard the word tax, and read this section. Where a person is allowed a deduction for a payment from which the person is required to withhold tax under division 2 of the Chapter 8, the deduction shall not be allowed until the tax withheld has been paid to the Commissioner General. Right. So there are different interpretations on this section, right? Different interpretations are there. One interpretation is, if there is requirement to deduct WST when making the payments, but you haven't deducted WST and paid to the CGIR, you cannot claim that expenses related to that payment as a expense in your taxable income computation. That's the most common understanding. I'm not going to explain it. So your exam, that understanding is very perfect, very enough. But if you are to go beyond that, see the terms. This is not for your exam. This is not for exam, but for your life, to explain how to read. Where a person is allowed a deduction for a payment from which the person is required to withhold tax, the deduction shall not be allowed until the tax withheld has been paid to Commissioner General. Read again. The deduction shall not be allowed until the tax withheld has been paid to CGIR, right? When there is a requirement to deduct WHT, you cannot deduct the expense if the tax withheld has not been paid to CGIR. So this is not for your exam, right? But for your life. Let's say I am making a rent payment, but I couldn't deduct WHT. So have I withheld tax? See the word. Have I withheld? No, I couldn't. I couldn't withheld. Now rent payment is, let's say, 200,000. 200,000. Let's explain here. Rent 200,000 per month, right? WHT. Now company A pays to company B. Company B 200, right? What happened is he pay 180 to this person and 20,000 to CGIR as WHT. So that's very easy now. What your in examination purpose, what happened? If you haven't deducted this, you cannot allow this. Now this 200,000 is a rent expense in your P&L. Rent expense in P&L, right? Company as P&L. If this happens, 20,000 you pay to CGIR, you can deduct this rent expense as a expense in your P&L, right? You can deduct it. But if you couldn't deduct, withhold this, if you couldn't withhold and pay to CGIR, what happens? They are saying you cannot allow this expense. You can't, rent expense you cannot deduct, right? That's understanding is very correct for your examination, right? We have to take that view. But what Act says actually, Act does not say like that. That's why I said in my introduction session, this tax knowledge are hidden, right? Chartered accountants always has to move to tax consultant to learn, get advice on this, because this knowledge is not shared among everyone. So what is required under law? Tax withheld, not remitted to CGR, cannot deduct as expense. So there is in this view it said that you couldn't withheld, so there is no tax withheld within you, no tax withheld in your hands, so you can't make payment to CGIR. So obvious that there is no application on this section. This section apply only if there is a tax withheld which is not remitted to CGIR, right? In a case that you couldn't withheld and you make the full payment, it is not applicable. That it is another view that tax consultants are bringing. But for your examination, don't apply that view. You stick on the view that if there is no WHT deduction has been made, that's the view that you should apply, and which is Department of Inland Revenue also applying, right? If there is a payment for which WHT need to be deducted, but if you couldn't deduct WHT and pay to CGIR, you can't allow that expense. That view you need to keep on to your examination, but in your practice, in your companies, you can apply different views, you can learn it in different ways, right? But for your examination, for you to get marks, remember, if there is a payment that's required to deduct WST and you couldn't deduct WST and pay to CGIR, then that payment cannot be deducted as an expense, right? Right. That payment cannot be deducted as an expense. So take that view. Now in our section, we will go to next part. So software license being obtained, no WST, WST deducted, hence allowed. In your question, for each note, student give some note, right? For each note, you need to mention something, right? Here you can mention as a note here. As a note, just add something and say license payments to or X allowed since WST deducted and no restriction under section 10, right? You better write everything here. License payment to RX allowed since WST deducted and no restriction under section 10. So no adjustment, but it's better to mention it to showcase your knowledge, right? With that you can showcase your knowledge, students. See, license payment to RX allowed since WST deducted and not restricted under section 10. So now examiner know that you know something on this subject, right? Examiner knows it. Right. We'll move on to next adjustment. 1 done, 2 done, 3 done. Next one. Capital allowance for the year were 1.4 million. Now capital allowance. You know what is capital allowance? Capital allowances are granted under section 16. I will show the section. Yeah. So in capital allowance granting, you need to remember two important things. Right. Remember this section. For the purpose of calculating person income from business for a year or so, the capital allowance referred to in subsection 2 shall be granted. Capital allowance referred to in subsection shall be deducted and subject to subsection 3 capital allowance referred to in subsection 2 shall be deducted and the balancing allowance allowed, right? This is the amended section which is prevailing now, right? This is before April and now this section is prevailing, right? Let's see. Capital allowance are granted in respect of depreciable assets owned and used by a person at the end of year of assessment in the production of the person's income from business, right? I'll give the summary what is important here. Capital allowance. Right? Capital allowance. Granted in respect of depreciable asset. depreciable assets, right? Granted in respect of depreciable asset. Very important, owned and used as of end of, this is also very important, right? This you need to remember. It's granted on depreciable assets which should be owned and used as of end of year of assessment, right? This is very important to remember. There are some assets that will be tested at the exam saying that there will be asset which is not used, working in progress, or maybe a machinery you bought but is still not used for production. Maybe a building you constructed but is still it is not used as an office, used as your building, right? So if it is not used even though you are owned, you cannot grant capital allowance. Another thing, I just shortly say, asset acquired under finance lease terms considered to be owned by you and used by you, then you can grant capital allowance, right? We will later discuss in detail on all these sections. So main thing to remember, see when you are reading the question, right, you remember to see whether asset is being owned and used by the company at the year end, right? It doesn't matter whether asset is acquired on last day of the year. If it is used at the last day even, you should grant capital allowance for the entire year of assessment, right? I hope you know that. In the year of disposal, no capital allowance grant for the entire year, but in the year of assessment, let's say it's acquired on last day, March 31st, for entire year, without considering it is there in only one date, if you use the asset and own at that last day, you have to grant capital allowance for entire year, right? So in our question, that need to be remembered, and let's see what is the application for capital allowance for the year were 1 million for 1.4, right? So we can allow it as a deduction, right? Plus minus, so we can allow it as a deduction. Now what happens is, students, here in this profit, you haven't deducted capital allowance. Now you go and deduct it. In arriving this profit, you haven't deducted any capital allowance. Now you go and deduct it, right? You go and deduct it here. So if you are deducting capital allowance, the required adjustment, next adjustment is disallowance of depreciation and amortization. Why you are disallowing this? Right? Now we learn many section. Now first, you better write a note when you doing the computer. You keep a separate note, 5 or 6 page. In each question, see what are the section that you are learning from each question, right? From each question, you mark what are the section that you are learning. Right. So disallowance comes from depreciation amount. Why you are disallowing it? Why you are disallowing it? It's because it's a notional depreciation. It's depreciation, accounting depreciation. For tax purpose you grant capital allowance. Tax asset you grant capital allowance. But for accounting purpose, this is a notional one, notional, not an actual cash expense, right? So notional expense are not allowed under section 10. You read section 10, you will find it is not allowed under section 10. I'll show you. So now in our way of teaching students, I am showing all the section when we are discussing the paper. If I am not showing it, we could have finished this question more earlier. But my target is to teach every section using questions. Here, see, 8. Not yet incurred. Expenditure losses not yet incurred, right? So your depreciation is kind of, you are creating a reserve by charging expense in a P&L. You are creating a reserve. You charge more and more expense, then you create a reserve. So this is not a expense incurred actually, it's a notional one, so you cannot allow, right? So depreciation and amortization, you can go to your question and find it and disallow. In your P&L, there was a P&L, see here depreciation and amortization given, depreciation and amortization given, you can disallow it, right? And grant the capital allowance. Here you granted it, not here. Yeah. Right. This one. So I am marking green color the adjustment. Now we are discussing one by one, right? So depreciation and amortization also we discussed. Next, gratuity paid by the company for the year was 834,620. So student, gratuity in similar same section, read, an amount that a person has transferred in his financial accounts to reserve or provision for expenditures or losses not yet incurred but expected to be incurred in a future year of assessment. So section 10, which is this is, the following deduction shall not be made in calculating person's income, right? So this calls provisions and notional expense. So gratuity which is in your P&L assumed to be provision, right? It's a provision. You know, in accounting standard you charge a provision in your P&L. Gratuity provision is debited to P&L and expense as expense and provision account credited, right? And payment, once payment made, it's made through provision account, right? So this is a notional expense. What is there in your P&L is a notional expense, right? So you have to disallow it, right? You have to disallow it, gratuity. Let's say gratuity, where we have gratuity in our questions. I'll come to payment part first, next. Right. Revenue direct expense. Gratuity 845,256. Here we have gratuity. right? This one 845 gratuity. So you disallow it. So you disallow this, right? Next, another gratuity also there. You assume it as a provision. Here, gratuity 364,256. Under overhead expense, it is 365,245. Right. That also you disallow. So you assume provisions are, you better write, provisions are disallowed. This is for your understanding purpose. At the exam, if time does not permit, you can skip writing this. Disallow under section 10. If you are taking a price, better to write this. No harm. Just under section 10 is enough. Disallow. Just disallow under section 10. This part is enough if at the exam. Disallow under section 10. Examiner knows why you are disallowing. These are simple adjustment. No? So you don't need much explanation. Even without explanation, it's fine. Your answer, suggested solution based on without notes, right? Without these kind of notes. But for your understanding, and if you are someone who's 𝐒𝐜𝐜 price, better to write these things, right? Here also disallowed under section 10. Here also disallowed under section 10, right? So why the payment has been given? Why payment has been given in this question? Why the payment has been given? Gratuity paid by the company for the year was 834,620. Now student, expense that does not incurred cannot be deducted. Gratuity provision in P&L is expense which is not incurred. So if it is not incurred, what have been incurred by the company? Actual gratuity payments. Payments mean maybe from cash payments, or you are liable to pay now, right? The paying event has been occurred, right? Person has requested gratuity, right? Once they resigned, they requested gratuity, right? Once they leave in the company, they requested gratuity, but still you haven't paid in cash. That's also incurred expense. That also can be deducted. But for our easiness, what many companies in the practice and many tax consultants are doing is they take the amount mentioned in your cash flow and gratuity note as gratuity payments as actual expense incurred. You are going in cash basis. You take cash amount paid as actual expense incurred. Now we disallowed expense that is not incurred, but now we need to find the amount incurred. What is the amount incurred? We assume cash payment made actually is the amount incurred. So we take this 834 as an actual expense. So we are deducting it. Now this thing already deducted. That means in Ravin profit before tax, these were deducted. So to negate that deduction, we added it back, right? Now this has not been deducted. This 834 has not been deducted in arriving this profit before tax. Now we need to deduct it. So we are adding it to minus column. Right? We take it to this column. Right? We are deducting it. So that adjustment also done. So in this act, student, no deduction shall made unless act says it specifically, right? So from which section you are deducting this? Capital allowance granted under section 16, under section 16, under which section you make this deduction, students? You have to understand this also. You deduct this using section main deduction, golden rule in this act, right? I call it as a golden rule in this act, right? Right, I'll show you. I have explained it earlier also. In calculating a person income from business or investment for a year of assessment, expense to the extent they are incurred during the year by the person and in the production of income from the business or investment shall be deducted. So expense should be incurred and in the production of income. So gratuity payment, we said it is incurred. You paid actual cash payment, right? Not the provision. This is the cash payment. It is incurred, right? It is incurred. And it is incurred in producing income from business. Now you are doing a business here in Sri Lanka, right? As a PE, you are doing a business. For you to do business, you need employees. Now employees are coming and they work and now they are leaving. You have to pay gratuity to them under Gratuity Act, right? So this arises because you did the business. You are doing the business in Sri Lanka. If you are not doing a business, you don't need to pay, you don't need to hire employees in first place and pay gratuity. But here this expense allowed because it is incurred in the production of income. You are allowed under section 11(1). Right? This is for your knowledge, right? Without explaining that also I could have gone, but I am explaining this. Under section 11, right? Many expense you are deducting using section 11, students. Section 11. Many are disallowed using section 10, right? Many are allowed using section 11. So that's free marks, right? You can show your colors to examiner by using this, right? Next adjustment, let's see. Assume withholding tax has been deducted on all payments subject to tax at the time of payment. There may be other payments. For all that, we are assuming that withholding tax has been deducted. So no more disallowance on the ground of section 10 subsection 2, right? Is that only relevant to, now it's this information relevant to individuals, right? Now our question is for Storm Company, PE. Now it's solved. Now we can go to P&L directly. Revenue, we computed proportion. Salaries, it's incurred under section 11. So can deducted. EPF also can deducted under 11. ETF also can deducted. Gratuity. Software license, we discussed. No WST has been deducted, so we allowed. Other income, interest income. Other income, what happened, student? Now here in this note, now we are in, now this is the computation format now. Now we are in note 1. We were in note 1, which is for business income computation. Now we are computing the business income using profit before tax, right? We compute business income using profit before tax. However, students, this interest income is not a business income for you. Someone can argue that interest income arises because I am doing business, I need bank accounts, likewise. No, those arguments are not correct because you invested in somewhere to the purpose of earning a interest income, investment income. So interest is a investment gain under section 7, right? Under section 7 it is an investment return, right? So it is an investment income. So in business income computation you have to remove it, right? Income considered separate, other source of income, you have to remove it. You have to remove it and bring under investment income computation. There is no any other adjustment for investment income, so you can include it under investment income directly without any notes, right? Without any notes you can include it under investment income, right? Next, let's see. This also adjusted. Now salary, CTF, gratuity. Very important one, head office expense. Before I am explaining this, we'll go to other. Rent. Only limitation that would be coming here is if there is a WST applicable. If you are not deducting WST, that could be disallowed. But there was a not given in the question saying assume all the WST has been deducted. So no problem. Utilities like electricity, water incurred in production of income you can deduct. Office expense also similar. You can say it's incurred in production of income, you can deduct. No adjustment. Depreciation adjusted. Professional charges. There could be charges by individual professional which is subject to WST under service fee income. However, we assume, question given that assume to all WST has been deducted. Staff welfare, there could be entertainment items, but in this question no note has been given. So we assume it as incurred in production of income, right? So almost all the adjustment has been done. And head office expense, there is an adjustment. Before that, I'll explain the adjustment first, right? Yeah. Right, student. Head office expense. So this is the main part that will be given marks, right? Section 79, student. Read this section. No deduction shall be allowed for an amount incurred by a non-resident person as an expenditure of a business carried on by the non-resident person through a Sri Lankan permanent establishment that represent head office expenditure where the amount would exceed 10% of the person's assessable income. Right. I'll come to explanation. Right. Head office expense, HO expense. What is this head office expense means, student? When there is a branch office, PE, in some country, now this is for that to student, let's say USA store, right? This is a one company and their branch in SL. For us it is a separate person. For IRA, Inland Revenue Act, it's a separate person. But for this company, it is one company. This is a one company, right? So this company always transacting with them, right? So this, let's say, this company has centralized. This is the group parent company, This has HR supporting services, finance supporting services, financial statements are reviewed by them, HR, IT support, all administrative support are given by the head office, right? Head office to this company. So head office, what they are saying is portion of expense are transferred to branch. They allocate expenses to branch in Sri Lanka, right? So let's say this is a huge group, they can allocate more and more expense to branch office in Sri Lanka, right? Sri Lankan overseas company, they can allocate more and more expenses, right? Imagine such kind of a branch operation in Sri Lanka. There are famous branches in Sri Lanka. Let's say Google, likewise, Oracle, likewise. There could be branch, not separate incorporated companies, right? There could be branches. Google they don't have, but there could be different by HSBC, right? Could be branch, right? So they can allocate many expenses to this company, right? Let's say their revenue is 100 million, they allocate 90 million expenses, which is incurred by the head office, not incurred by them. So tax that they are paying very low in Sri Lanka, right? Tax that they are paying very low in Sri Lanka. Therefore, what they do is, what the act says, it is an anti-avoidance provision, students. So you can understand that more and more they claim expense, their taxable profit get lower than tax liability is low. To prevent that, Acts introduce anti-avoidance provision, saying that if your head office expense are more than 10% of your taxable income, no deduction shall be allowed, right? No deduction shall be allowed. Let's see, read this. No deduction shall be allowed. First one, no deduction shall be allowed. No deduction shall be allowed. Right? Let's understand this section. No deduction. No deduction shall be allowed. Allowed, right? You understand it's this in your own way. For an amount incurred by a non-resident person as an expenditure of business carried on by that non-resident person through a Sri Lankan permanent establishment that represent head office expenditure. So from entire para it says, no deduction shall be allowed for amount incurred that represent head office expenditure. Shall be allowed one amount incurred that represent head office expense, right? No deduction allowed for head office expense, and they are giving condition. Now, where the amount would exceed 10% of the person's assessable income. If said amount, this amount exceed 10% of accessible. Student, by looking at this, understand the section. So, is this saying if the head office, again and again you read this section, right? This is very important. There are Supreme Court cases, that cases going on to Supreme Court level, right? That's why I am taking time to explain this, right? There are actual cases that I have been faced, right? There are cases, right? So, understand, students, it says no deduction shall be allowed. Is it saying that only the deduction which is above 10% is not allowed? Is it saying that deduction which is above 10% is not allowed? No, it says no deduction shall be allowed. Nothing at all. If you are increasing your head office expenses more than 10%, nothing at all, right? No deduction if amount exceed 10%. No deduction if amount exceed 10%. Isn't it, student? Read it again. No deduction shall be allowed where the amount would exceed 10% of the person's assessable income. No amount is allowed. It does not say amount exceeding 10% cannot be allowed. There is no wording like that. It says no amount. Nothing can be allowed. Right? It says nothing can be allowed. So, if your head office expense is more than 10% of your assessable income, you can't deduct any of the head office expense by the word meaning, students, right? That's the view that IRD is taking, and which is taken to the court level also, right? Some consultants are maybe in different views, saying it can be allowed, right? But what IRD is taking is this view. So, unless there is another DTA provision application likewise thing, in simple analysis, right, there could be many complex areas. You are analyzing DTA, under DTA there might be saying you can deduct all the expense, there couldn't be any expense, there would be discriminative provision come into play, non-discriminative provisions. Likewise, there will be many other areas if you are done, but for this much of marks, you don't need to analyze all those provisions, right? But in simple terms, without going into DTA, OECD commentaries, UN commentaries, and other applicable laws, human rights, like non-discrimination provisions, without going on to all those, in simple terms, what this section says, student, you cannot deduct any expense. You cannot deduct any expense on head office expense if it is exceeding your assessable income more than to 10%, right? That's what's mentioned here. Under non-discrimination provision, student, if it is applicable, you can argue this provision is not applied to you, right? Then you can fully allow this, right, without limiting this onto this. That's more beyond. That's analysis more beyond. That sometimes even tax consultants are not aware on that, right? So don't go into that much deep, but that understanding is your level understanding is this. But however, in your suggested solution, what does the examiner doing is, what he do is, he fully disallow it, and this is your suggested solution, and grant now firstly you have to check whether it is exceeding 10%. No, for that you do adjustment before head office expense 1. So you take summation of plus column, take summation of minus column, right? So that is before adjustment. You find the assessable income from business before adjustment. 15 minus 7, your assessable income is 7.3, right? 10% on that is 700,000, right? But here you have 16 million head office expense, 16 million head office expense. So it is more than your assessable income, more than your 10% of assessable income, right? So then what your suggested solution is doing is, they are disallowing entire amount and granting 10% only. They are granting 10%, but I don't know, student, from what wording they are granting 10%. What IRD taking the view as, you cannot grant entire 16% as expense, right? Entire 16 million as an expense, right? But your suggested solution is grant value exceeding 10%. 10% of value within the adjusted business profit. 10% on tax assessable income they are granting as a allowable expense, right? Only disallowing, effectively disallowing only value exceeding 10%. Disallow total, then again deduct 10% of assessable income. So they are granting this, but I don't know under what provision. There is no provision, student. Now you have seen that provision, no? Under DTA, non-discrimination disclosure, you can fully allow it, but for your level, that analysis is not relevant for you, right? Some tax consultants are also not aware about that. I am pretty sure on that, right? Your level, you need to have fresh understanding on your section. This says 10. In this cases, student, you have to look at single act also. Single act prevails if there is any inconsistencies, right? So it's better if you refer the single act also. But it's very clear, no deduction shall be allowed, right? That's the view IRD is taking, and Tax Appeal Commission also approved that decision in certain cases, right, students? So this is the view. In that view that I have disallowed the entire head office expense. I have added it back in my answer, right? In that you mention, you better explain section 79. Under section 79, no deduction allowed if head office expense exceed 10% of assessable income. So you can read it again and again and understand what it says. This is a good research for you, right? So one research is find the way that you fully allow this. There is a method, but it is not relevant for you. It's very deep, many commentaries, OECD commentaries, everything we have to analyze. It's not at your level, right? It's beyond your level, right? So beyond your level means you need to read more and more. Now you are at final level, no? Beyond your level, there is no level, but you need to read more and more, right? At your examination level, the examiner would not test that level, right? But here, in plain English, what is the correct way is disallowing the entire amount. So read again and again that section and comes if you have a different view to say that the suggested solutions are correct. right? So I don't find any section that says, only 10% can be allowed, right? No section says that only 10% can be allowed. No section in the act says like that. If someone find it, just let me know. I don't believe that section, but there are methods to fully allow this. That is not at your level, right? It's require comprehensive research on this subject. So this is correct. Don't afraid of doing things that is mentioned in the act. You have to mention under what section you are doing it. Under section, no deduction allowed if head office expense exceed 10%. So you disallow full. Then you take the assessable income, students. You take 15 plus 16, 31 minus column, then 24, right? So assessable income is 24. Now you have arrived at accessible income from business and investment also there. Now 29 is the accessible income. Next question, students, we discussed earlier revenue proportion. I said at the end of the question we will understand. We prepared this table, right? We taken foreign revenue, local revenue, taken the proportion, right? Now you take this 24 million, this accessible income from business, you take here, firstly, you take here and find the relevant accessible income for foreign income and relevant accessible income that is attributable to local income. How you do it? 24 you multiply by the foreign income revenue, 64%, equal 15 million. 24 you multiply by 36%, which is equal to local revenue. So you take it, you mention it in this table. Why it is important? To apply tax rates, students. Right, tax rate. Tax rate is, student, business income local 30%, business income foreign 15%, investment income, that is balance 30%, right? So business income we have computed in that note number 1A, 30% is only 8 million. Yeah, 8 million, and 15% tax rate apply for 15 million. We take this here, right? It's a simple mathematics one, linking one. So I hope it's clear for and investment income. You always check whether this total is equal to this, right? This total is equal to this. Yes, equal. So you multiply this. So you multiply 8 million into 30%, 15 million into 15%, investment income into 30%. You take the tax liability, right? Gross tax liability. Now, next important thing, is that the only liability that you are having? Is that the only liability that you are having? See, students, in our question, they are asking to compute the income tax payment including remittance tax. Now, what is this remittance tax, students? Let's understand it. Remittance tax. Remittance tax, right? Student, it comes under section 62, right? Section 62, right? A non-resident person who carries on business in Sri Lanka through Sri Lankan permanent establishment shall pay tax on the remitted profit earned within the year of assessment. Remitted profit, right? So it's kind of non-resident person doing business in Sri Lanka. they earn some income and pay taxes 30% on that, let's assume, right? And next, after tax profit, they remit to their parent in abroad, right? Foreign country. They pay tax 30% here, and after profit after tax, they are remitting to foreign country. That also again getting taxed, right? That also again getting taxed. Why? It's aligned with international taxing principles, students, right? It's aligned. It's not a double taxing. You are doing activity here as a local person and you pay tax as a local person. And if you are sending that to another country, that will be getting taxed, right? And there are certain exemption also. We'll see. Sri Lanka but tax on remitted profit. Here it says remitted profit, but question does not say profit has been remitted, given abroad. Understand this correctly, students. When we are reading a balance part, you will understand. Remitted tax, it does not need to remit entire profit to that country, right? If you want to pay on accrual basis, you can pay on each. In practice we are doing, right? Even without remitting it, you can pay the tax, right? Non-resident person who has who has earned remitted profit under subsection 1 shall pay a final tax on the gross amount of the remitted profit to the Commissioner General in accordance with the rate set out in first schedule to this Act on or before 30th day succeeding date of making such remittance. When you make the remittance, due date is on or before 30th day of succeeding period, right? Provided, however, if non-resident person retain the total income earned in any year of assessment commencing on or after April 1st, 2021 in Sri Lanka for a minimum period of 3 years. Now you are retained the profit, you don't remit it, you don't send it abroad, you retain it. Then what happens? For a minimum period of 3 years commencing from the first day of immediately succeeding the year of assessment in which the income is earned and invested the same in Sri Lanka. You earn, now this is let's say year of assessment 23-24, you earned income and you keep it for a 3 years, immediately succeed in that year of assessment, right? And then you not only keep it with you, you invested the same in Sri Lanka to expand its business or to acquire shares of securities from Colombo Stock Exchange listed by Securities and Exchange Commission of Sri Lanka, or to acquire any treasury bill, treasury bond, Sri Lankan international sovereign bond issued on behalf of the government of Sri Lanka. The tax rate on remittance of such retained income in which shall be 0%. If you invest that retained profit after tax for your business growth, right? You have to develop your business, you have to show it, not that you just keep it in a separate safe or bank account, right? You have to develop your own business in Sri Lanka. Or you have to invest in T-bill, T-bond, sovereign bond or CSE, Colombo Stock Exchange, right? Then tax rate is 0. Otherwise, tax rate is 14% under Schedule 1 to the Act, right? We'll see. In this section, remitted profit means amount remitted though retained abroad out of the profit and income of the non-resident person that are subject to income tax in Sri Lanka and any amount received outside Sri Lanka by or on behalf of the non-resident person from conducting business in Sri Lanka that is subject to income tax in Sri Lanka, excluding dividends paid by the resident company to the non-resident person. Right? In this student, there are foreign projects, let's say for road development project, Chinese projects. What they are doing, students, they don't keep it in Sri Lanka to invest in that part of income, right? What they are doing is they just send it abroad in later dates. So let's say any company can elect to, under accrual basis accounting under section 20, pay remittance tax as and when income is earned without waiting until profit has been remitted to other countries. So in this question, you can assume that they are paying remittance tax as and when earned the profit after tax, right? So remitted tax means a separate tax, right? It is not WH, it is not WST, right? I am saying it again and again. In practice, I have seen many even tax professionals get it wrong. They are saying it is a WST. No, this is a separate tax type is there, separate code is there to pay the payment, right? So it is a separate tax, remitted tax, which is equal to profit after tax, right? So its tax rate is 14% and 0% if you invest it in Sri Lanka. On remitted profit, right? 14% under schedule 1 or 0% if invested for 3 years in developing own business, government glitz, we say government bills glitz, or CSC, Colombo Stock Exchange shares, right? If you invest for 3 years, this is remittance tax on profit after tax, right? So see, just one question, how many sections that we are discussing.